Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. Shares of Nike crashed 20% in late June after the sneaker maker issued sales guidance that came in well below analyst estimates and fueled concerns about more market share losses to smaller rivals like Hoka and On. That was the stock's biggest one-day fall in more than 2 decades, and Nike's shares have now slumped nearly 60% since peaking in 2021. That sent Nike's dividend yield to around 2%, which is double the company's 5-year average yield. With sales and earnings declining and no quick fixes for the company's challenges, some investors are wondering if Nike's dividend remains on solid ground and if the firm's best days could be behind it, in which case the stock could have a lot more downside even from here. We'll dig into both of these issues in today's video. I'll also share a little bit about what Warren Buffett has said about the company. There's a lot to unpack here, but the easiest argument to start with is that Nike's dividend remains well supported for now. Using Simply Safe Dividends, you can see that we have reaffirmed Nike's dividend safety score of 99, which falls in our very safe bucket and implies that odds of a dividend cut remain very low. Scrolling down the page, you can see that Nike has demonstrated a strong commitment to its dividend over the decades, including 22 consecutive years of raises and safe payouts every quarter since declaring its first dividend in 1984. While the stock's yield is somewhat low, Nike's dividend has tripled in size over the past decade as it compounded at a double-digit rate. While near-term dividend growth could be a little bit more moderate until profits rebound, Nike's payout is well covered by the firm's earnings and free cash flow, even in the tough operating environment that seems likely to persist in the year ahead. Nike's payout ratio sits near 50% and indicates that the company is generating about $2 of profit for every $1 of dividends it pays out. This provides a healthy margin of safety since Nike's earnings would need to get cut in half from here to no longer cover the dividend, which is an unlikely scenario for such an entrenched business that has historically delivered stable, double-digit profit margins. Nike investors can also take some comfort in the company's pristine balance sheet, which holds more cash than debt and earns a AA- credit rating from S&P, which is strong investment grade. Debt payments always take priority over dividends, but Nike has no need to strengthen its balance sheet during this challenging period. But are Nike's best days behind it? That question is much harder to answer, but it determines whether the company becomes a value trap. If you've been investing long enough and tried to catch a few falling knives like I have, you've probably learned the hard way that the market is often pretty smart and bad situations can have a way of getting even worse, regardless of what rosy analyst estimates might say. These can also be some of the best buying opportunities, though, especially if a company's long-term outlook is eventually proven to remain intact. However, these judgment calls can be pretty difficult, especially in faster-moving industries like fashion. Warren Buffett and Charlie Munger humbly spoke to these challenges at Berkshire Hathaway's 1993 shareholder meeting when an investor asked them for their thoughts on the competitive advantages and business economics of Nike and Reebok. Here's what they had to say.
I don't understand their competitive position and the likelihood of permanence of their competitive position over a 10 or 20-year period, as well as I think I understand the position of Brown and Dexter. That doesn't mean I think that it's inferior. It doesn't mean that I think that we've got better businesses or anything. I think we've got very good businesses, but I haven't done the work, and I'm not sure if I did the work I would understand them. I think they are harder to understand, frankly, and to develop a fix on than our kinds. But they may be easier for other people who just have a better insight into that kind of business. Some businesses are a lot easier to understand than others. And Charlie and I don't like difficult problems. I mean, if something is hard to figure, we'd rather multiply by 3 than by pi. I mean, it's just easier for us.
Essentially, Buffett viewed Nike as a fashion stock that depended more on the whims of unpredictable consumer tastes than possessing some sort of durable competitive advantage. With limited confidence in forecasting what Nike could look like in 10 to 20 years, he was content with passing on the stock. Nike's sales were less than $4 billion in 1993 when Buffett made those comments, and they now top $50 billion. While you might think this durability would change Berkshire's mind on Nike, Charlie Munger reiterated his thoughts in an interview with the Acquired podcast in 2023, saying that he doesn't like style companies except for luxury handbag maker Hermes, since it has built trust with its customers for nearly 200 years.
Japanese trading companies reminds me, we studied another company recently, Nike, that is That's a
was
very
surprising
different
to me.
company.
Yeah.
That's
Did you ever look at
that's
it?
a style company. Well, of course I've looked at it, but I don't like style companies.
Too fad driven?
Well, I suppose if Orby Hermes is achieving a price, I'd buy it. But short of that, I'm going to buy any style company.
I wanted to share these remarks so we can all look at Nike with some humility. While this is one of America's most iconic brands, maybe this time is different. The biggest concern is market share losses to upstart competitors Hoka and On Running, which were both founded in 2010 and have seen significant growth in recent years, thanks largely to the unique cushioning technologies they have developed that have resonated with consumers. Each brand's sales now top $2 billion, up from a few $100 million before the pandemic, and representing around 500% growth over that period. Nike branded footwear grew more than 30% during that same time frame and stands much taller with $33 billion in sales. But this business is now shrinking while Hoka and On continue ripping off double-digit growth and expanding their product lines well beyond running shoes. Now, the fickle nature of fashion means these brands still have a lot to prove, though. It wasn't that long ago that many analysts were convinced that Under Armour would be the next Nike after it grew its sales from under $500 million to over $5 billion in just over a decade, but Under Armour ultimately faltered with numerous execution challenges and has seen its stock decline 80% since going public. Competing with Nike is no piece of cake. The company spent over $4 billion last year alone on advertising and promotion costs, including endorsement contracts with top athletes and sports teams who use its products to build brand credibility and visibility with everyday consumers. This marketing spending is more than Hoka and On's combined revenue and almost as much as Under Armour's annual sales. It also doesn't include the money Nike is pouring into research and development to better meet today's consumer preferences that have put Hoka and On in the spotlight. Several new product launches are also planned to coincide with this year's Summer Olympics, and Nike is also working to restore relationships with retailers like Foot Locker after reducing its distribution with them in recent years to prioritize its own direct-to-consumer business. None of these are quick fixes, and the backdrop could get worse if consumers further tighten their spending on non-essential goods like new shoes. But long-term investors who believe Nike will remain a force in the footwear world could find the stock interesting after its latest sell-off, which has put Nike's PE ratio below its historical norm. We'd guess Nike's issues are ultimately fixable, and we like its exposure to long-term growth markets like China, which accounts for 15% of sales, but we'll keep a close eye on its turnaround as there are no sure bets in the fashion world. I hope this video gave you some helpful perspective on Nike. If you enjoyed our analysis, it would really help me out if you considered liking the video and even subscribing to our channel, which will stay focused on analyzing different dividend stocks and funds and also just sharing practical investing tips. If you have your own dividend portfolio, you might also be interested in checking out our website, Simply Safe Dividends. We provide all the tools and research you need to generate safer income, make better informed investment decisions, and ultimately help tune out the market's noise. Thanks again for watching, and I hope to catch you next time.